Can you get to where you want to be in the future as a retiree without investing?
It isn't really a choice, not for most people who are employed. Things are very different to how they were 30 years ago.
The truth is, there's no real magic about this. There are some basic, simple rules about investing, which if you follow them, you will end up better off.
I came at it with fresh eyes and looked at it and thought, this is like a club, an exclusive club.
The financial industry does not help itself, and it does not help its customers.
We do want to debunk some of the myths. We want to talk about it from the perspective of people who are curious and want to get started, but also people who are on a journey of investing already and keep making some of the same old mistakes. What do you think, in all your time as a financial journalist, is what's really holding people back?
Loss aversion. Essentially, the emotional reaction you get to losing £1 is much greater than the emotional reaction you get to making £1.
When is the time to get rid of something? I can't leave a job. I struggle to dump people. I hold on to things way, way longer. What's been your biggest humdinger?
Oh my God.
You mentioned AI there. There is talk of a bubble and a crash coming. Is there anything that you can do, though, to prepare yourself for this inevitable crash? If you are an average person investor, though, or you were about to start investing, the question is now the right time to do it? We're having to make bigger decisions about our money and our financial futures than ever, often without proper advice and surrounded by a lot of noise. All of that's happening against a backdrop of higher living costs, messy politics, and plenty of economic uncertainty. Add in jumpy markets, social media full of tips, some useful, some frankly dangerous, plus a load of jargon, and it's no wonder that investing can feel daunting. Well, along with our expert guests, we'll break it all down to help you make the most of your money, whether you're brand new to investing or you just want to feel more confident about the decisions that you're making. Welcome to Investing Unlocked. Making money makes sense. I'm Georgie Frost.
And I'm Simon Lambert.
And who better to kick us off and uncover some of the truths about investing than the man who just wrote the book about it? Jonathan Guthrie, investing journalist of many decades, former editor of Lex, the FT's flagship investment commentary column, and the author of The Truth About Investing, Debunking Myths for Better Returns. Simon, though, before we speak to Jonathan, firstly, you've been covering this stuff for longer than me. What feels different now?
Well, firstly, the government is about to tell us all that we should be investing more, and it's about to go on a campaign to try to get people to invest. Now, one of those reasons is because it wants people to invest in the UK stock market. Arguably, it may be the case that even if people do invest more and the government is successful, they won't actually invest any more money into the UK stock market, which brings me on to the next point of why is this important. Why this is important is because even for those people who are investing, they face a conundrum at the moment, which is that the global stock market is hugely dominated by the US stock market. The US stock market is hugely dominated by a relatively small number of giant US tech firms, but returns have been spectacularly good. And if you have been invested over the past 5 years, you've done very well. So people need to make up their mind as to whether they invest and then how they invest, and also whether they just go with the market or try to do it in another way.
I have to ask you the question, though, Simon. Can you get to where you want to be in the future as a retiree without investing? You said if you choose whether you want to invest. Is this a choice?
It isn't really a choice, not for most people who are employed. Most people who are employed, certainly in the private sector, will be investing into a pension. So they'll pay some money into a pension, their company will pay some money into a pension, it builds up a pot, and when they retire, they need to turn that pot into income in retirement. And most of those people are probably going to remain invested in retirement. So people are committing to a life of investing now when they start work. Things are very different to how they were 30 years ago, for example, where companies took responsibility.
Exactly. And that's the point, is people have more responsibility now, as I said, over their money and their financial future than I think they ever have before. But with that, we've got more choice. Well, let's bring in our guest, Jonathan Guthrie. Absolutely delighted to have you. I enjoyed your book immensely. The question is, though, Jonathan, what is the truth about investing?
Well, I'm delighted to be here. Obviously, I would like people to buy the book to unpack all the detail, but
Yeah.
I think that there are some basic, simple rules about investing, which if you follow them, you will end up better off. The truth is, there's no real magic about this. Despite all the expensive seminars that you can go on, despite all the claims that investment professionals will make, if you gradually invest a trickle into your funds over extended periods of time, and then you hold on for extended periods of time, and I'm talking about 7 years plus, you will come out a lot better than if you sit on cash. And you should also remove money in stages. Try to avoid timing the market, and then you should beat inflation and you will have more money in the long run.
It's all right, Jonathan. The show is only about 45 minutes long, so you're not going to be giving away all the secrets in this
Good to
episode,
know.
but some of them. And we do want to debunk some of the myths. We want to talk about it from the perspective of people who are curious and want to get started, but also people who are on a journey of investing already and keep making some of the same old mistakes. So we're going to get into that in more detail. But I want you just to answer a little bit about what Simon just approached then, was kind of what's the point about investing? Now, clearly people are watching, so they know there is a point, but just spell it out to us. For us as individuals, for the government who want to get us investing, but for the general kind of economic well-being of a country, break it down for us. Like, what is the point?
Well, I guess there are two layers to this, really. There's the personal layer, and what I would argue is that you need to invest so that you will be better off in the long term. A lot more people are needing to make investment decisions, as Simon mentioned, the pension schemes where now the investment risk resides with you as the member. It doesn't reside with the company that you work for. There are also about 9 million people who are running their own portfolios on DIY platforms, the kind of AJ Bell's, the Hargreaves Lansdown of this world. Then the second layer is, what's the purpose of it? What does it do economically? It provides investment capital for business, fundamentally, and hopefully it contributes to economic growth. That's something that the government's anxious about. Whether you think it's your role to do that as some kind of patriotic duty or not is a good question. Personally, I don't really believe that. I think that you ought to be looking for good returns where you can find them, because for the most part, it's going to be down to you how you fare in life, later in life, perhaps when you're a pensioner.
There's loads of research, isn't there, Simon? Because we talk about this a lot, about people who have, a fair amount of money, but that still don't invest. And I suppose this goes to the heart of debunking the myths, because one of them is that, well, investing is just gambling, isn't it? And where that came from, historically, you could say lots of booms and busts may have contributed to that. But actually what you're doing is, especially if you're investing in the stock market, you're buying something tangible. You're buying little pieces of company. But what do you think, in all your time as a financial journalist, is what's really holding people back?
I think there's a number of things that hold people back, but I think it's the fear of doing something wrong and the fear of losing money are the two main ones. And I think
Jonathan's agreeing with you there.
This is borne out when you speak to people from the investment platforms, isn't it? Where they say that actually they've got the hurdle of getting people to sign up to the platform, but then they've got the hurdle of actually getting people to put their money into something. And the huge number of people who put money into their account and then don't actually invest it. And they say it's not because they're worried about buying the best possible investment, it's because they're worried about buying a bad one and losing money.
Exactly. So this is a very common phenomenon that everybody shares. Lots of research on it, something called loss aversion. Essentially, the emotional reaction you get to losing £1 is much greater than the emotional reaction you get to making £1. And that's why people sit on huge amounts of cash, which is actually probably falling in value when inflation's applied to it. If they invested in equities for the long term, over long periods of years, they've got a very good chance of beating inflation.
And I think it's also worth noting that if you do stick with cash, right, and there are people who stick with cash, there are people who have large amounts in savings balances, and there are lots of people who are very successful in life who end up with large savings balances. And that is because, they probably should have invested, and then they end up with a big pot, and it's like, well, if I start now and I lose money, I'm going to lose a load of money. But if you do stick with cash, you need to then make sure that you have your money in the best possible savings account at any given time. And what I see time and time again with people who, are readers, with people I speak to, is that not only do they have probably more cash than they need, but it's sitting in legacy accounts where it's earning much less interest than it possibly could be. So instead of getting their 4.5% a year, they're getting 2% a year. And that's where they're really losing out.
It's an awkward thing to have to deal with. People shy away from it. Clear out the shed instead. Take your car to the garage, but don't deal with the thousands of pounds you've got sitting on deposit.
Why is that, do you reckon? Yeah, because it's true, we do. I'll do anything other than have to sort out my financial admin. But why is
that? It's a bias, isn't it? We prefer to deal with things that we think we understand and we're comfortable with. And it's also the fear of risk.
I saw a meme on Instagram, which was a smug-looking guy who said, that's me having used the term macroeconomic headwind instead of saying things are tough. And that's the thing, the language, and I'm not going to make any bones about it. There are sections of this book which, some of the terms, because look, if you want to go really deep into it, yeah, of course, there's, parts of it are incredibly complicated. But I do feel the industry, and I am someone that came as a sports journalist into finance over a decade ago, with not the most amount of financial knowledge. So I came at it with fresh eyes and looked at it and thought, this is like a club, an exclusive club. And that meme to me was a bit like, I think people are quite proud to have this sort of language and terminology that they use, which can exclude people like me.
Yeah, absolutely. So I use some technical terms. I explain them, I hope, reasonably well. The jargon is there for two reasons. It's there so that people who are in the know can communicate with each other conveniently. And it's there so that people in the know can keep other people out. And a lot of the time, as you say, Georgie, they're really just ways of creating a bit of a kind of priestly or scientific aura to quite great and overwhelming ignorance.
I mean, the other thing I would say as well is that the financial industry does not help itself, and it does not help its customers, in the sense that, for example, if you take ETFs, to use a bit of jargon.
What's an ETF, Simon?
An ETF is an exchange-traded fund. It is a fund where investors put their money in, and it's all pulled together, and then it's invested in a basket of different investments. Usually, it just follows that basket. It just tracks it.
Right.
And ETFs have been, effectively, they've been a way of rebuilding the whole world of investing. They're the new thing. They are also full of acronyms and jargon and unbelievably difficult to navigate your way around trying to work out the one that you want.
Yep.
Even if you're a financial journalist with a couple of decades under your belt. So how normal people are meant to do this, I don't know. There is no reason why they couldn't be easily named after what they do.
Simon makes a good point. The advice that if you're just getting started is to just stick your money in a global tracker ETF on a platform and kind of forget about it. But there are so many choices, even within those two simple choices, that if you are just getting started, which do you pick? How do you work out what's the best platform? What's the best ETF for you?
I think that investing's really pretty simple. It's a bit like a DIY project. You have a particular outcome that you want to achieve, put some shelves up, for example. You've got a budget for doing that. Then you need some tools and some materials. That's maybe your DIY investment platform and the funds that you put the money into. And you just have to plan it in the same kind of way, effectively. The reality is that you do have to make investment choices, but they don't necessarily need to be very big ones. The idea that you do not have to make investment choices is an illusion, frankly. If you buy a world index fund, because of the huge scale and the enormous rise in the US stock market, you will end up about 75% exposed to the US.
What's the problem with
And,
that?
well, that might be fine. But if you live in the UK and your liabilities are mostly in pounds sterling, you might not want to have the currency exposure. You might not also want to take a very big risk on AI, for example. You might not be comfortable with that. What you need to think about is, what kind of returns would I like to make adjusted for the risk I'm willing to live with? What can I sleep with at night in terms of what's in my portfolio? So you might want to be a bit more cautious. The other reality is that if you don't invest, somebody else may be doing it for you. For example, once again, back to the pension schemes that Simon mentioned, where you as the individual take investment risk, probably if you've been contributing, your money's being shunted into what's referred to as a lifestyle fund. And what that means is it goes from risky to less risky over a period of years as you get older. You may not want to actually be less risky when you're 60. You might figure, I'm going to live to be 85, 87. I want to go on taking equity risk. So the reality is you are not immune to investment risk, nor are you immune to underperforming, to losing money against inflation, which is what will probably happen to you if you put all your money in cash. So you probably need to just get a little bit of a grasp of it in the same way you do that when you buy a house. You develop some understanding of the housing market, and the basics are not that hard.
You've answered my question beautifully, which might not be the best question for an investing podcast, which is, if you can just stick your money and set it up very simply with a platform into a world index, why do you need to learn about investing at all? But you've absolutely just answered that. One question I really do want you to talk about, though, is you mentioned AI there. There is talk of a bubble and a crash coming. Is it inevitable? And is it a disaster if it happens?
This is the many, many millions of dollars question.
Trillions.
The trillions of dollars question. Without doubt, there are a relatively small number of companies whose share prices have been driven up hugely by hopes over AI, and also what I would describe as the ultra profits that big tech firms have been making over recent years, and that some of that comes before the AI hype. You can't expect these things to continue to go on forever. If you look at some of these companies, you might think that they are ultimately priced for perfection. The difficulty is that if they do take a tumble, it's likely that if they take a big tumble, all will take a tumble at the same time, but also that everything else will take a tumble. The question is then what happens next? What we have seen repeatedly over at least the last 5 years is that every time they do, people buy back into those companies and their share prices go back up. But there will come a time when that doesn't happen anymore. And I think people just need to recognize that. And as Jonathan just said, they just need to recognize that global tracker fund is taking a very, very big sort of, it's not a bet, but taking a very, very big position on potentially a relatively narrow trade. But investing against that has cost people lots of money in recent years because they've passed up all the returns that they could have picked up. And also, if you do invest against that, you are ultimately saying, I am smarter than the entire global market. I know more than all of those people put together. And it might be that you don't.
And as we know, some famous fund managers have not succeeded that over recent years, have they?
No, I have known quite a few Dr. Dooms over the course of my career writing about investment who have said the market's about to crash. And well, we know that, all right. Markets are pretty unstable things, and I've seen maybe 5 proper crashes during my career. The question is when? And the problem for the Dr. Dooms is that generally they go on insisting the market's going to crash until they lose their jobs, and then the market crashes. The thing about AI is we've seen quite a few different next big things in technology, haven't we, Simon? Things like the Internet of Things, yeah?
The metaverse. I mean, does anyone
Yeah.
remember the metaverse?
So where is your avatar on the metaverse, and how often is your fridge signalling to a supermarket that you need more, I don't know, eggs or milk?
And actually, if you look at some of the stuff around the AI bubble and the concerns over it, there are concerns over the circular deals that are being done by some of these companies. There are concerns over some of the companies at the middle of it that aren't necessarily making money. There are concerns that some of the companies that are making lots of money have gone from being what were termed capital light businesses, where they didn't have to plow loads of money into physical things, to actually spending unbelievable amounts of money on data centers. And then there is a concern that the end customer for these AI products just isn't really there, that businesses aren't seeing a great return on it. It's not saying that AI is not going to be a massively disruptive technology.
Yeah.
It's just, it might be a bit overhyped right now.
And it's the timing. We'll probably see a crash, and then maybe they'll make a lot of money, lots more money from it, because that's what happened with the internet, right? Big crash in the year 2000, and then enormous profits for businesses like Meta in recent years.
Before we carry on, a quick word from our sponsor, PensionBee. If you're listening to this podcast, chances are you care a bit about investing and making the most of your money. Here's the thing, though. You don't have to be a pensioner to care about your pension. In fact, the earlier you pay attention, the more powerful it can be. Your pension is likely to be one of, if not the biggest investment you have, yet it's often the one people ignore for the longest. That's where PensionBee comes in. They're a leading online pension provider focused on helping people build confidence and take real control of their retirement savings at any stage of their life. Their app and website make it easy to combine old pension pots, manage contributions flexibly, and see exactly what's happening with your money, all in one place. You can also access your pension from age 55, rising to 57 from 2028. If you want to take a more active role in your pension investing, download the PensionBee app or visit their website to get started. Remember, when investing, your capital is at risk. So if you are an average person investor, though, or you were about to start investing, the question is now the right time to do it? Because with prices so high and then you experience a crash, is there not a danger that for those people who believe that it was gambling, it was too risky for them, and they finally, like the government wants, put their money in, invested, and then all of a sudden they just see the bottom fall out?
Yeah, I would say you should start as soon as you can. If you're investing for the long term, if you're investing for your kids, for example, you're investing for your retirement, you need long periods of years, preferably decades to do it. So don't think that you're going to time the market. You aren't going to do any better than the professionals most of the time. And certainly in a crash, you won't be able to get out as fast as they can. They'll get out before you because they've got the mechanisms to do that. Invest gradually over extended periods of time. Enjoy the growth that creates through your returns, producing more returns, and take the money out gradually as well. Then you don't have to be an investment market timing genius to do reasonably well out of it over an extended period of years.
There are a number of studies, and there are lots of articles written about this. I'm sure Jonathan's written some, I've written some over the years, about how investors manage to actually underperform their own funds. Because they managed to buy in at the wrong time and sell out at the wrong time. That is the warning against market timing. And I don't think I could count on one hand the amount of professional investors I have met who have recommended trying to time the markets. It is notoriously difficult to do, even for those people employed by large multinational corporations with a huge research staff at their disposal. And I think ultimately, if you get really, really unlucky and you put a lump sum in at the absolute peak of the market, and then the market does crash, you obviously have a problem. You will have to wait for it to go back up. But if you are investing a small amount over a long period of time, then those bumps will be smoothed out and you will benefit from the times when prices go up, and when prices go down, you'll just get to buy more for your money. In most things that we buy in life, we want to buy them when they're on sale. Broadly speaking, we actively seek to pay less for stuff rather than more for stuff. And just think about stock markets being down in that sense.
And yet there's plenty of evidence that says we buy too high and then we don't buy when things have gone down. Again, psychology coming in, and we're our own worst enemy.
This is why private investors, this is why amateur investors do badly on the whole, because they tend to buy when the market's high and they tend to sell on the dips. You're trying to do it the other way around, really. If you don't want to bother with that at all, you just invest through the cycle.
Is there anything that you can do, though, to prepare yourself for this inevitable crash?
Then you get into timing, which means, for
Have
example,
a pot of cash ready just in case.
Then you get into timing and pulling out of the market and sitting on cash. But as Simon says, you may then sit there drumming your heels while for month after month the market continues to go up.
I have made the mistake where I had quite a good AI stock, was doing really well. And then I listened to all the noise, thought the market would crash, sold, and it's still going up. Oh, well, never mind. At least I made a profit, huh?
Well, there's an opposite to that, of course, which is that you become attached to a stock which you believe in and it goes down and down and down. I've done this. And then you decide, well, I think it can make it to £10 a share or something like that. It's at 7 or 8 and it goes down another pound. And then you think, well, it's still going to get back to £10 because I think that's what it's worth. The reality is that the share isn't going to be sad if you sell it. It doesn't have emotions.
There was also a wonderful moment when you cut an absolute humdinger of a loser from your portfolio.
Liberating.
And then every time you ever look at your portfolio again,
it's not
you
there.
no longer have to look at that stinker.
Yeah.
And that is a nice feeling.
That sounds like a man speaking from experience there, Simon.
I am speaking from experience here. Also, the maths of if something is down 75%, how much it needs to go back up to get to 100% is quite astonishing.
It is.
And it's probably not going to happen.
What's been your biggest humdinger?
Oh, my God. Well, there's been a number over the years. The first one, actually, which taught me a valuable lesson was HMV shares.
Oh, wow.
Right, so this is going back some time. HMV was effectively the only music shop left on the high street. And
Are they still
it was
HMVs?
paying, it's gone bust a couple of times and come back a couple of times since then.
It's a sort of legacy brand, isn't it?
Yeah, exactly. And there came a point, I think this is sort of 2006-ish kind of thing, when I first started investing and writing about money and stuff like that. And I thought they literally cannot fail here because they have the whole market sewn up. Bearing in mind this is before streaming took off and everything like that. But also they were talking about, if you cast your mind back that far, they were talking about trying to take advantage of the sort of early days of this. It was like, you'd be able to go in and then be able to choose your songs and then you'd be able to get them on a CD kind of thing.
Juice bar as well.
Yeah, exactly. They were also, they're selling merch and things like that. I thought they can't fail. It paid I think it was just a 10% dividend. It was an astonishing dividend.
What's a dividend?
That is a amount of money that a company pays its shareholders to reward them for paying the shares.
Do they always pay
holding
out?
the shares. No, they don't always pay out. Not all companies pay dividends, but it's a way of paying back some money to
Like a thank
shareholders.
you.
Yeah, a thank you. Now, what you could do instead is you could invest that money back into the business. But some businesses decide it's better to pay that money back to shareholders rather than invest in the business. Anyway, it turned out that I had completely underestimated the stupidity of the people running HMV.
Right.
Who decided to branch out into all kinds of things. I think music venues was one. Then they started deciding to try to sell something else within the shop. And it turned out that they completely squandered the last music shop on the high street advantage. They completely squandered any advantage that they could possibly have had in getting in on, trying the way the music industry was changing. And I watched those shares go down and down and down. And then HMV eventually went bust, and the dividend was obviously cancelled and gone forever. So that was one, and it was a sort of, there it goes. And then I think another one was smaller company gold mining shares. Now the gold boom in the kind of, I reckon it was like maybe 2010-ish, or might have been a bit earlier than that. I remember having a conversation with someone in the investment industry, and they were telling me...
Sure thing, probably.
Sure thing,
yeah.
Basically, there was a gap between gold, which had been going up a lot, and gold mining shares, and particularly smaller company gold mining shares. And if that gap had to close, they said, and therefore there was a huge opportunity here. So I put probably more money than I should have done at the time, considering how little I had, into a smaller company's gold mining shares fund. And they were right. The gap did close. but it closed due to the fact that the gold price came down.
And the shares didn't go down quite as much.
And the shares didn't go down by quite as much, but they did go down by a lot. And at one point, I think I ended up down about 40 or 50%. And that was one that I did. HMV I just held on to until it went bust. That was one that I did sell and ditch from my portfolio. And I must admit, it was a liberating moment that I never had to open my investment account again and look at my mistake. And I could take the rest of the money that was left and put it into something better.
And Jonathan, this is from someone who knows a fair bit about money. But there was a bit of, I think it might be called FOMO that you had there, or someone says to you it's a sure thing. You do not want to miss the boat on that, do you?
It's FOMO, and it's also I would be very wary of people who were very persuasive and put forward a very good argument for things. And then there are many people within the investment industry.
High apparent levels of expertise.
Yeah. Going back to the point you made about the US, I read something the other day. I don't have the exact figures, so I can't quote them. But the astonishing difference in how much people who invest in the US are worth versus how much people who invest on average in the UK are worth is really quite huge. People in the US are substantially wealthier than people in the UK because they invest their money.
Only 23% of UK adults have invested in the stock market outside of pensions. Compare that to 2/3 that own stocks in the US. And UK adults hold about 8% of their financial wealth in investments outside pensions, which is the lowest among G7 countries. It's 33% in the US. Why that gap?
The culture's different. One of the things that is very different is an attitude towards new things. And the stock markets are a great place to try out new ideas. Some of them work and some of them don't. Some of them are disasters. I think in America, there's more of an attitude that when a company doesn't work out, if it turns out, for example, to be built as a house of cards, the electric truck company, which posted a video of a truck apparently speeding along a highway, in fact, it was rolling downhill. People are a little bit more philosophical about it. It's a bit less of a scandal. And there's a culture of risk-taking there too. Go to parties. I remember going to parties decades ago, frankly, embarrassingly long ago, in the US, ordinary Americans there, they were talking about stock options, right? That's quite a complicated, that's a kind of almost an investment on top of an investment. You're investing indirectly in the price of a share. And they weren't investment professionals, but to them, it was quite an interesting thing to do. You wouldn't hear that at a British cocktail party, I don't think.
But I asked Simon this at the start, do you feel like now is almost a turning point, slightly different?
I hope so. Yeah, I think it would be good if we were a bit more accepting of risk and also of the idea that stock market floats are something of an experiment. It's to see whether something's going to work out or not. So if you think about Tesla, right, and Elon Musk, hugely controversial character for very good reasons. But the interesting thing that he did was he showed old-fashioned commentators like me that we were wrong. We thought it would be tough for him to build a company that made a lot of electric cars, manufactured a lot of electric cars from the ground up. And he actually did that because American investors gave him enormous amounts of investment capital to do it. Meanwhile, in the UK, you've seen some cutting-edge projects of established businesses cancelled because they wanted £1 billion, £2 billion to do it, and the investors wouldn't pay up. The city wouldn't pay up.
You mentioned there Elon Musk. I won't go too much into Tesla and all that, but actually, Simon, speaking about the companies that you invested in, especially HMV, and how the ownership, perhaps the leadership wasn't quite as good as it should be, make some decisions. But what should you be looking at if you are wanting to invest in a company? Is it as simple as, let's say you want to invest in a restaurant chain and you just go in, and if you notice the lights are out and they're not serving avocado anymore because of cost, that you don't invest there? I mean, what should you be looking for?
Yeah, I mean, the lights are out or the carpet tiles are worn are actually not such a bad way of looking at it. There's a kind of bit of a rule of thumb that some private equity-owned businesses...
Private equity? Just explain that.
So these are companies that buy other businesses own them privately for a while and then sell them to somebody else. Private equity owned companies, they will replace a single carpet tile rather than replace the whole carpet. It's that kind of...
Because they're just in it for a short-term profit, right?
It's underinvestment, exactly. But I would suggest there are two strands to this, right? So for a mature business, does it seem to have a sustainable business? People want the products and it's actually paying reasonable payouts to shareholders, right? So these are businesses that have been established for a long time. That is not going to apply to a startup. A startup, even quite a big one, which is trying to grab market share, is not going to be paying out a lot to investors. So the test there is, do you believe in their fundamental proposition or not? And old-fashioned city stockbrokers had a phrase for this. They talked about death or glory stocks. And the cool, slightly scientific modern version of that is a binary proposition. Yes or no. Do you think it's going to shoot the light out or isn't it? And probably data and numbers and fancy mathematical calculations are more distracting than helpful in deciding that.
We're all looking, aren't we, for the next Nvidia, the next Amazon. Were there signs that we can look out for and think, yeah, that's it? Or did people just luck out if they bought in early?
There were signs, and if you'd paid attention, then you probably could have got in on before Nvidia's share price absolutely shot up, and actually probably before Amazon's absolutely shot up. You would have needed to know what you were looking for and what you were listening for, and then paid attention to what people were saying. You wouldn't have got in at the beginning. It's highly unlikely. But when Nvidia shifted from being a computer chip maker for video games to suddenly starting to do well making chips that were ideal for AI, or when people decided its chips were actually ideal for AI. They were made for computer games, but because of the way they process stuff, it was really good for AI. There will have been stories about that. People will have been talking about it. And if you were looking into that particular part of the market, you would have heard about it. Amazon, I do remember reading lots of stories and starting to see stuff about how it was making lots and lots of money from AWS, Amazon Web Services, where basically Amazon suddenly became effectively the cloud computing for half of the internet. And all of a sudden it stopped being a sell an unbelievable amount of stuff business that you're making very small margins on to try and make money, to doing some really, really high margin business. And you could have paid attention to that and you could have got into it. But I think individual company investing is difficult because you have to be paying attention. If you are going to hold a portfolio of shares, you need to hold at least 15 to 20 different companies. And they need to be 15 to 20 different companies that do different things.
Right.
There can't be 15 to 20 companies that all do a similar thing, right? Because they're all going to go up, they're all going to go down together. And then you need to do your research properly on them. You need to look at what they do. You need to look at their company reports. You need to look at the balance sheets. You need to ascertain whether that company looks cheap or expensive compared to its competitors and its rivals. Is it worth paying a high price for because it's going to have all this growth? And then you need to keep an eye on it once you've bought it. And most people just do not have the time for that. Once upon a time, I thought I had the time for that. I don't have the time for that at all. My portfolio has a long tail of small shareholdings that I bought over the years. I read about this, read about that. And I thought, yeah, I could do that. I'm actually interested in it, right?
Yeah, exactly.
So, I'm actually interested in this. Turns out I didn't have the time at all.
So what do you do instead?
The answer to that is simply to use someone else's expertise and to use investment funds. I should have my pension is largely in cheap tracker funds that we talked about and just follow the market. My ISA is largely more in active investment funds and investment trusts, which are just like an investment fund, but they are listed on the stock market themselves. And effectively what I'm doing is I'm outsourcing it to other people who know more than I do and whose job it actually is to look into individual companies and do all that work. And even then, they quite often don't get it right. But, and there's discussions around fees because you have to pay money for these funds. If you buy a tracker fund, it will be cheap or should be cheap. If you buy one where a fund manager is making decisions, it will be more expensive. It might charge you 1% a year. But many of them might charge you less. I've got investment trusts, for example, that charge 0.6%. Now, to me, that's a relatively small amount for somebody else to do a load of work for me.
Yeah.
Right? But it's more than I'd be paying just to follow the market, and that person might get it wrong.
Bringing up fees, I think, is really important, and I can't let that one lie, because I think when we're first starting out investing, if you see fees of maybe 1.5%, you think, oh, that's tiny. But over time, so fees are really important, especially when you're picking sort of a platform, trading fees. What fees should you be looking for? And explain why such a small amount can make such a big difference.
Sure. Well, in terms of platforms, you want to look for a low fee. All in, I think most people would say 1% for that. If they've got quite a lot of exposure to trackers, they would expect it's going to be 1%. Maybe half of that's the platform fee, roughly half of that's the annual fee for the tracker. And then you maybe pay a bit more for actively managed funds. And as Simon explained, these are ones where you've got someone trying to pick opportunities. The way I do it is I use some active managed funds for things which seem more specialized these days. I don't really want an active manager picking big stocks in the UK or US for me, because really they're probably not doing anything that different to a tracker, and they're charging me more for it. Something like smaller companies in Asia, then I'm willing to do that. Smaller companies in Germany, I've got some active funds to do that for me. And to get to the second part of your question, a lot of what we're talking about comes down to compounding. Most of us can do percentages. What we tend to forget about is the effect of a percentage that we've made in growth then producing growth of its own. Bit like when you're getting interest on a savings account and each year's interest then earns you some more interest. It's a snowball effect. It's really, really powerful over a period of years, and we forget about it. And equally, if you're paying high charges, you're chipping away at that snowball effect because it recurs yearly.
There are two things that I really want to ask you before we end, because I think whenever I hear about investing, they come up all the time. And the first one is Simon mentioned eggs in a basket. This is diversification, which slightly doesn't make sense to me, because you don't want all your eggs in 2 baskets or 3 baskets. What you want is your eggs in a cardboard container, in a basket, I wouldn't recommend putting eggs in a plastic bag, but the idea is what you want to have different things that you're putting your eggs, being your money, in. And the other thing is risk. You mentioned risk, but actually sometimes the biggest risk is doing nothing and leaving your money in cash, as we spoke about. So diversification.
Yeah, so diversification is swings and roundabouts, right? If we want to come up with a phrase for it that sounds a bit less pseudo-scientific, really. And the point about that is that you will do better on some things, you will do worse on some things, but you should be able to sleep at night. If you take very big concentrated risks, you take all of your money and you shove it on. I know someone who did this, right? He actually invested, I think it was in Amazon, in the noughties, and he did very well. He owns a chateau in France now.
Lovely.
But then there will be people who put all their money in one stock and lost it all, and you don't hear about the chateau in France. So the point is, it's about what you're comfortable with. So the most important thing when you're looking at your returns is to think about the risk that you took. You might have been beaten by somebody who got 12% when you got 7%. You might have been undershot by someone who got 3%. The question is, when you started out, were you in a position that you were comfortable with?
And then the second part, as I spoke about, was risk. What do we mean by risk? How do you work out what risk tolerance that you are happy with?
I suppose it's how much money can you afford to lose? Because the more you diversify, the lower the amount that you are exposed to.
Which is an incredibly personal thing, because some people feel very frightened to not have tons and tons of money just sitting there.
But you have to be realistic about it and remember the danger that your money is going to be eroded by inflation if you stay in cash. So you've got to understand your returns right at the end of the day. Once you've done all your deductions and all your additions, what are you left with? have you made money at tolerable risk to you? That's the thing you've got to try and understand and come to a conclusion about for yourself.
I think you need to ask yourself the question of, if I open my investment account one day and it's down 30%, how will I deal with that and how will I feel? What will I do? Am I likely to suddenly panic and go, I need to sell it all now because I can't handle it falling any further? Am I likely to think, well, do you know what? It's down 30% now, but it'll be up another day. And if I don't need to actually sell those investments now, it doesn't matter to me because it's only on paper. Or are you the kind of person who's going to open it and go, oh, it's down 30%. I've got some money in the bank. I'm going to buy some more shares. And the answers to those kind of questions is how you ascertain what your attitude to risk is. And as Jonathan said, you can invest in investments where you are taking more risk, and you can invest in investments where you are taking less risk. And if you're starting out, you can get your investment platform or where you invest to do almost all of the work for you, because I guarantee you they will have some very simple, very cheap funds that are labeled by risk levels. And you can go, okay, I'm going to go higher risk, I'm going to go medium risk, or I'm going to go lower risk. And you accept that if you go lower risk, chances are you're probably going to make a lower percentage return each year. Not guaranteed. Sometimes you pick a lower risk fund and it goes up like the clappers. If you pick higher risk, you might make a higher percentage each year, but you are more likely that you're going to open that portfolio one day and it's going to be down 30%.
Problem is, I don't know about you, but if I'm looking at something like that says higher risk, medium risk, lower risk, my instinct is always like, well, I don't want to go too high and I don't want to go too low, so I'll just go in the middle. And if I'm like 25 years old, then that's probably not the best thing to do, right?
But you see, you've just perfectly illustrated your point, because I'm an idiot, so I look at it and I see it as a challenge. I'm like, oh, I'll have high risk.
Yes, yeah. Well, this is sort of investment as a competitive sport,
it's a personality thing, though,
Yeah.
isn't it, right? And a lot of this does come down to who you are and what you're comfortable with, right?
I mean, you're absolutely right. And if you are a 25-year-old, you can afford to take a bit more risk because you've got far longer for it to be smoothed out.
I would be remiss if I didn't have 50 years of cover. You're looking at me like, God, 50 years is about 50 years of investment journalism experience in the room with me. Not to ask what you think the role of the financial press is kind of now, I think, in an environment of social media. Because I do think, and I mentioned at the start, there are so many influencers. Some are excellent, but some are frankly dangerous. With so much noise, with so much, you can earn this amount of money, just invest here, more than we've, I think, ever seen. I mean, of course, that sort of scam is as old as day, but now you've got such a much larger distribution with social media. What role does the financial media have to play, do you think?
I think it's to dispel bullshit and nonsense, isn't it?
Great, yeah.
Yeah?
Let's hope so.
One of the things you see with bulletin boards, particularly this was something that happened in the US 2 or 3 years ago, was private investors talking up bombed out stocks, and then they'd spike up like crazy, which is very exciting because it hurt some of the professional investors. But the reality is that some of the folks starting those stories about everybody pile into this or that stock were hoping that would push the price up so they could sell out to somebody else. And it's called the biggest fool theory in investing, which is, can you find a bigger fool to take your shares when they're riding high?
Which is great until you end up being the biggest fool and you're the person that everybody else makes the money off. I think my argument would be that the voice of the financial media is the voice of sanity nowadays. We used to get lambasted for sensationalizing things, and you still do. Stock market falls and you get the headline, 5 billion wiped off the FTSE or whatever, but actually compared to what goes on social media, which is totally unregulated, and there is no comeback on anyone really saying anything on social media, within the actual financial press, there is a responsibility, and I think there's also a desire to explain things and to engage readers. And if we are bound to say things that are true, and if we don't say things that are true, we can get called up on it, and we have to print corrections, and nobody wants to be that person, and you end up getting in trouble. And if you have too many of them, it's out the door, sunshine. So you do not have that on the social media platforms.
Final thing I want to ask is about, can you develop an investing mindset? I know, Simon, you said everyone could be an investor. I know my foibles, just listening to what you were saying there about knowing when is the time to get rid of something. I can't leave a job. I struggle to dump people. I hold on to things way, way longer. I mean, I suppose acknowledging one's, errors is the first step to any solution. But a tip for anyone, whether you want to get started with investing or you want to get better at investing, how to develop a great investing mindset?
Pragmatism.
Okay.
I think it's the DIY project. This is not intellectually that challenging. You've got lots of quant funds, weird fund managers who are doing all kinds of strange things, hedge fund managers. But if you're a private investor, you're not in that game. You're not trading currencies intraday or something like that, even if adverts tell you that you should. You're pragmatic. You do it gradually. You do it over a period of years, and you come out gradually as well.
Simon?
Habit. Turn it into a habit. As humans, we pick up habits incredibly easily, and we really struggle to break them. So just turn it into a habit. Automate everything you possibly can. Get the money out of your account on payday into your investment account. Get it set up so it's regular monthly investing. Build up that habit. And once you've built up that habit, you probably won't stop. And avoid stopping as well. Watch out for the traps where you suddenly go, oh, actually, because of this, I'm just going to stop that automated payment, because chances are you probably won't start it again.
Fabulous. Now it's time for the £1,000 move. Jonathan, I want you to imagine I'm giving you £1,000. Unfortunately, I'm not. What would you do with it?
If someone just gave me £1,000, I think I would probably invest. I'd probably invest £500 of it and put it aside. And because I'm fantastically old, I would spend £500 of it on having fun. Because one thing which retirees or the semi-retired often do is they cling on to the money that they've saved. They don't spend very much of it. And then when they get into much later life, they can't.
Fabulous. What would you invest the 500 in, though?
500, I probably shouldn't be saying this because of what I said before. I might sit on it for a little while just to see what the US market does.
And Simon, finally, Simon says,
I would say the thing to think about is, why does investing in the stock market work? And ultimately what you're doing, if you buy a broad global tracker fund, as Jonathan said, is you're investing money into thousands of companies that are listed on the stock market around the world. And you are backing their ability to take money, put it to productive use, and make profits. And those that do make a profit will do well, and their share prices will go up. And those that can't make a profit will do badly, and their share prices will go down. But eventually they'll drop out of the basket and new ones will come in at the bottom. And if those companies couldn't put money to productive use and make a profit, they just keep it in the bank. So that's where your returns as an investor come from. All of those companies around the world having the ability to make a profit.
Simon, thank you so much. Jonathan, thank you so much. And I do recommend reading Jonathan's book, The Truth About Investing, Debunking Myths for Better Returns. Jonathan, at times it is a little bit difficult. At some points, people might find it difficult, but it's something that you can dip into and out of, and whenever you're ready. And there are some bits that you don't need to know, as you mentioned, about companies. And there are lots here that will help you in wherever you are on your investing journey. So fabulous book.
Thank you so much for inviting me. And I think the first few chapters, if you're a beginner, are for you.
Absolutely brilliant. Thank you so much. Thank you so much for joining us. If you want to get in touch with us, you can find us on social or you can email us. Remember to hit subscribe so you don't miss an episode, and make sure to tell your friends about us too. If you enjoy Investing Unlocked, especially our retirement episode, then I think you'll enjoy this from our sponsor Pension Bee, the Pension Confident podcast. Hosted by Philippa Lamb alongside a panel of financial experts, it's aimed at those who want to understand pensions and personal finance in a bit more depth without the jargon. They cover topics like ISAs, mortgages, the bank of mum and dad, as well as how to become a pension millionaire and the cost of divorce. There are new episodes every month, plus bonus content in between. You can listen on all major podcast platforms, in the Pension Bee app, or watch it on YouTube. Just remember, anything discussed isn't financial advice, and when investing, your capital is at risk. Search the Pension Confident podcast wherever you listen. Before you go, just a quick reminder that everything you've heard on this podcast is for information and education only. It's not personal financial advice, investing involves risk, and if you're unsure, it's best to speak to a regulated financial advisor.